Hey guys, this is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profit newsletter, coming to you from down here in Central Florida. The torrential rains of the last week have finally left us. We can walk outside now without worrying about being hit by a passing arc after we had 4 or 5 days of just constant rain. The sun is back out. We're back into kind of a normal Florida. Really hot, nice afternoon. Maybe we'll get our little 15-minute thunderstorm, but the rains have kind of calmed down, and that's a good thing, especially for those poor folks over in Tampa who are now using boats to get around, as I understand. It's been kind of a strong week. The S&P's up 1.45%. The all-world URTH index is up 2.33%. That's helped by quantitative easing in Europe and China's decision to outlaw selling of just about any form to prop that market up. And the community bank index continues to come along. It's up 0.67% this week in what has been so far a quiet week for the index, but a great week for the small banks in our portfolio. We've had some outrageous earnings increases, dividend increases, new stock buybacks being announced. It's been a great week for us as small bank stock investors. Now, somebody walked up to me the other day. We were having a conversation, and we talked, of course, about bank stocks and a little bit of baseball. And he happened to mention to me, he said, hey, that deep value stuff that you do, that's not really working too well right now. Now, I got to tell you, folks, my chess game needs a little work, actually a lot of work, because I'm way too aggressive and I never play defense and I don't win very much. My gin rummy game, it's kind of coming along now that I'm playing more often on the computer. I do okay with that. I'm a pretty decent writer, horrible editor, lousy typist. There's things I'm good at, there's things I'm not good at. Math is one of those things that I'm actually pretty good at. I am aware that we are down. It's somewhere right around 6.5% for the year so far in the main deep value portfolio, and most of the damage comes from oil. Now, when we started Deep Value 2 years ago, we talked a lot about, and I still do, the private equity mindset. We buy these stocks looking out not a year, not really even 2. I think my average holding period through my career is probably a little over 4. And with the oil stocks, I'm willing to wait. Now, David Rubenstein of Carlyle Group, who is in the same situation I am, by the way, if you read their quarterly earnings report last week, they got hammered by their oil-related investment. He was on CNBC this week, and he said, oil is probably going to be the best investment in the world for a long-term investor. Now, this guy's been in the private equity business for, I think, the better part of 3 decades. When he says something's the best long-term investment in the world, my ears kind of peak up a little bit. Now, he said that in time, prices are going to come back, demand will come back, prices will move higher when demand catches up with supply. And he remains very bullish on it in spite of the fact that they did take some substantial losses. I think their losses in the oil patch make ours look almost like gains. So long term, the oil thing, I'm not that worried about it. We have oil and resources stocks. We have silver stocks. That one might be a little shakier than the oil stocks. But if you remember, back in January, we did kind of a house cleaning. We got rid of everything that did not have rock solid credit scores and asset values backing up the shares of the stock that we own. So we've continued to move down on some of them, but looking out to 2020, I'm just not that concerned about where my oil stocks will be. The short term, okay, being up is more fun than being down. We all know that, and it's more fun to talk about. But I can handle being down a few percentage points in the portfolio right now because looking out, again, to the 2018-2020 period, these stocks are going to make me a ton of money. I'm highly confident in that. I do not think that alternative fuels have reached anywhere near the efficiency and cost level to fully replace carbon-based fuels. Might happen in another 2 decades, but it's not happening over the next 5 years. Oil demand will come back, prices will go higher. We'll end up doing very, very well on the stocks. Now, we did study a lot of different things about, what mistakes did we make in oil, why were we too early? Because I don't like being early, but I'd rather, be buying right about now, to be honest with you. I think prices are a little more attractive in the sector than certainly when we were buying heavily in December of last year. Now, what we found out, I ran a bunch of tests and studies. That's one of my favorite things to do. You may notice that we have a new backdrop. We've moved my office back upstairs in the house and got all the computers Peter's just a little quieter up here, not quite all the rigmarole we have downstairs with the barking dog and the singing child and all that. And I've spent a lot of time since we moved this up here earlier this week just running numbers, crunching numbers, doing tests. And I talked earlier this year about the fact that we discovered that if you went to liquidation value instead of book value with very strict credit controls, you actually improved performance, although you did narrow the pool of available candidates considerably. But what I really found interesting was that when I went back and I ran these screens and I looked at what stocks we would have been buying, if we focused on liquidation value or less instead of just a discount to book value with the tighter credit standards, we wouldn't have been buying any oil stocks at all last year or in December of this year, where we bought some good companies that have just continued to go down, and a few of them now actually trade below liquidation value. Under that system, this would actually be the time to start buying them. And we're going to try to kind of incorporate some of this new information into how we approach the market and pick stocks. Certainly the higher credit standards, I'll never abandon those again in my lifetime, because it just removes so much risk overall from the portfolio. But there does seem to be some merit to waiting for the stocks to hit liquidation value instead of just book value. Now, I'd like to say that this is a completely original, wonderful idea that I thought of all on my own, but of course Peter Cundall was doing it this way for many, many years, and racked up some pretty impressive returns in the process. So we're going to kind of incorporate that into what we do at Deep Value. We're still not seeing a long list, if I run the screen today, of stocks trading below liquidation value with strong credit scores. Not many names on there, and we do own the majority of names on the list. Not doing a lot of buying. We did a little bit of buying over the past couple of weeks, some special situation of going private transaction, and a few closed-end funds trading at what I think are abnormally high discounts. We're not rushing out to buy. I think we're still about 55% in cash. I'm comfortable with that. If you look at any reasonable measure of the market, we can argue about the Shiller PE, but that's extraordinarily high. We can't really argue about market cap to GDP. It's been a very effective measurement, although not precise, timing mechanism of when the stock market's full or fairly valued. Right now, it's pretty overvalued on that measure, as is the Tobin's Q ratio, which has been another pretty good indicator of when is a great time to buy stocks. Nothing in this market strikes me as what Charlie Munger would call an extraordinary opportunity, so we're simply not rushing to spend the cash. There's no need to be in a hurry here. Now let's just see what else we have here. Banks continue to work. They are an extraordinary opportunity. This past weekend, both the Wall Street Journal and the Economist had articles about the demise of and shrinking of the U.S. banking industry, primarily on the community bank side. One fellow who was a very successful banker here in the United States has taken his business over to Britain, where it's not quite as difficult for a smaller bank to survive, apparently, and is doing very well. But he said that we've gone from, during his career in the late 70s through today, from about 25,000 banks down to about 7. He thinks we eventually end up around 500. I think that's extreme, but we are going to shrink probably by at least half from here. And folks, these banks aren't going out of business, okay? This is not like all these little banks are failing. They're being bought as people attempt to buy assets and earnings and achieve scale to spread out the costs of the higher regulatory compliance and, of course, the very expensive technology that you have to spend money on today, both on the mobile banking side, customer service, and of course cybersecurity is a huge issue, and it's not a cheap fix. So the smaller banks, they're looking for somebody to sell. They're not going to sell for less than book value. In fact, the average takeover multiple is about 1.35% times book right now, and we're buying them at about 82% of book on average on our buy list last week. So there's a tremendous opportunity. Book values are growing. The multiples are going to start accelerating, creating that double compounding effect that I like to talk about. So we had 26 small bank stocks on our list. Average price to book value of 82%, most of which had an activist or bank stock specialist as a shareholder of the bank, kind of increasing the odds in our favor substantially. This is an extraordinary opportunity. If you're not involved in it, I simply do not know why. I'm going to put another link in here this week. If you don't subscribe to Banking on Profits, guys, please do so. You will thank me, and your brokerage balances will thank me over time. It's a very, what I think is a low risk, very high return opportunity, and it's going to last for the better part of the next decade. So please join us in making all that money from the very small community banks. I think it's a tremendous opportunity. I was chatting with Tobias Carlisle yesterday. Tobias, great guy, co-author of Quantitative Value along with Wesley Gray. And of course, last year he wrote Deep Value. And Tobias has done a lot of work using enterprise values. Enterprise value to EBIT is pretty close to what he likes to call the acquirer's multiple. And I have to tell you, he's convinced me. There's no question about it. This is a fantastic measure of deep value. It is as good as book value, but now, I'm not going to replace price to book value, guys. That would be stupid. It's worked for 30 years. No reason to think it won't work for the next 30 years, particularly with tighter credit controls that we installed in January of this year. I ran all the tests. The enterprise value to EBIT approach does offer returns as high as price to book value. They're actually a little less lumpy than price to book value, so you have a little steadier return process over time. Also, when I ran this, just on its own, we found that list had the same problem as every other value list. Over the last 2 years, it's been littered with energy stocks. And however, all I had to do was add a simple measure like the Altman Z-score of over 3, and all the oil stocks went away and are just now starting to show back up onto the list of very cheap stocks as measured by enterprise value to the EBITDA multiple. It's a very good multiple. We're going to add it to the toolbox. We have used it for a while in the income portfolio because, limiting price to book and high dividend yield, you would have a hard time putting a portfolio of 25 stocks together, which is our target number for that portfolio. And so we added the enterprise value to EBIT. We've actually had some very solid winners using that. So we're going to incorporate it a little bit more across all of the portfolios in the deep value portfolio. It does not work on financial stocks at all, so it won't become part of the bank portfolio, but we're doing pretty daggone good on price to book value just all by itself in that portfolio. So anyway, that's about all we've got from down here in Central Florida. It's not a great book release month. August is generally a little bit of the doldrums, but the W.E.B. Griffin has a new book coming out today in the Badge of Honor series. I've already downloaded it to my Kindle, so that's how we'll be spending the evening here. The Orioles don't play till almost my bedtime tonight out on the West Coast, so we'll catch up with them in the morning. But baseball is starting to get a little bit more serious. Those pennant races are going to get a little tougher, so it's a fun time to be a baseball fan as well. So that's all I've got down here in Central Florida. I hope you guys have a great week, and I'll talk to you all next week.